Hey there, smart listeners. Welcome back to Smart Credit Bytes. I'm your host Sangeeta, and if you're new here, this is where we break down everything about business credit in bite-sized pieces that actually make sense. No complications, no confusion, just real talk about real money matters. Today I've got something that's going to save some of your money and months of frustration. We are diving deep into the top 5 reasons why MSME loans get rejected. More importantly, how you can dodge these bullets completely. Now, before we jump in, let me tell you a story. Last week, I got a call from Priya. She runs a small textile business in Delhi. She had been rejected for a loan 3 times in 6 months. Sounds a lot, right? 3 times. When she told me her story, I realized she was making the same mistake I see over and over again. By the end of our conversation, we had finally identified exactly what was going wrong. Now, after a week later, her loan got approved. Same business, same financials. But this time she knew the game. That's what we are here for today. To make sure you know the game too. Alright, let's get real about something first. MSME loan rejection rates in India hover around 40 to 50%. That means actually half of all applications get a fake fat no. But here's the thing, most of these rejections are completely avoidable if you know what banks are really looking for. So let's break it down one reason at a time. Number one, and this is the big one, poor credit scores. Now I know what you are thinking, but I pay my bills on time. Here's the thing though, when banks look at MSME application, they are not just checking your personal credit score, they are looking at your business credit score too. And most of the business owners have no idea this even exists. Let me paint you a picture. Rajesh runs a small manufacturing unit. His personal civil score is 780. Pretty solid, right? But his business credit score, it was sitting at 550. Can you imagine? Because he had been late on a few supplier payments 2 years ago that he completely forgot about. The bank saw the business score and immediately put his application in the rejection file. Didn't matter that his personal score was great. Now you will ask how to avoid this. So, first check your personal and business credit score every quarter. Yes, every quarter. There are free ways to do this, Sibyl for personal and platforms like Griff or Experian for your business credit. Third, and this is crucial, if you are just starting out and don't have a business credit history, start building it now. Get a small business credit card, take a tiny working capital loan, for you can easily repay. Build that history before you need that big money. Reason number 2 is something that make me want to pull my hair out because it's so easily fixable and complete. That is incomplete or inconsistent documentation. I can't tell you how many times I have seen application get rejected not because the business was not good enough but because the paperwork was just a mess. Here's what typically happens. You rush to get your documents together. You pull bank statements from different months. Your GST return doesn't match your bank deposit. Your financial statement looks like they were prepared by 3 different accountants who have never met each other. The bank looks at this and thinks, if they can't even organize their paperwork, how are they going to manage our money? The golden rule here is consistency. Everything should tell the same story. Your bank statement should match your GST returns, which should match your financial statement, and that should match your ITR. How to avoid this? Create a loan application checklist 3 months before you actually need the money. Yes, 3 months. Get all documents in order. Make sure everything matches. And here's a pro tip. Get your CA to review everything before you submit. A small fee paid to your chartered accountant upfront can save you months of back and forth with the bank later. Also, digitize everything. Banks love digital documentation because it's easier for them to verify. Physical documents can be lost, damaged, or delayed. Digital document, they are there instantly. Number 3, and this one subtle but deadly, inconsistent cash flow patterns. Now, every business has ups and downs, right? Bank know this, but what they don't know is erratic, unpredictable cash flows that they can't make sense of. I had a client who ran a small business, ice cream manufacturing. Their cash flow looked like crazy on papers. Huge spikes in summer, almost nothing in winter. The bank rejected them because they couldn't understand the pattern. But here's the thing, once we explained the seasonal nature of the business and provided them 3 years of data showing the same pattern, the next bank approved them immediately. What lesson have you learned? Context is everything. Now, how you can avoid this? First, maintain at least 12 months of clean bank statements before applying. No random cash deposit, no mixing personal and business transaction, no unexplained large withdrawals. Second, if your business is seasonal or cyclical, prepare a simple explanation with historical data. Show the bank what looks like chaos to them actually has a predictable pattern. Third, if you have had a genuinely bad month of quarter due to external factors like COVID, natural disaster, market changes, prepare a brief explanation with supporting document. Don't just hope they won't notice. Address it head on. Reason number 4 hits a lot of small businesses hard. Inadequate or unclear collateral. Here's what most people don't understand about collateral. It's not just about the value of what you are offering. It's about how easily the bank can liquidate if the things go wrong. A client of mine offered land worth 50 lakhs as collateral for a 20 lakh loan. Sound like more than enough, right? No, you are wrong. The land was in rural area with unclear titles and ongoing family disputes. The bank took one look and said thanks, but no thanks. Bank want collateral that is clearly titled, easily valued, quickly sellable, and legally clean. Now, how you can avoid this? Before you apply, get your collateral professionally valued. Don't guess, get a proper valuation from a certified valuer. Make sure all your property documents are clear and updated. If there are any legal issues, resolve them first. If you don't have traditional collateral, look into credit guarantee fund schemes. These are government-backed programs that provide guarantees to banks, reducing their risk and collateral requirements. And here's the thing most people miss. Liquid collateral is always better than fixed collateral. Fixed deposits, mutual funds, even life insurance policy can work as collateral and are much easier for banks to understand the value. And finally, we come to reason number 5. The one that separates serious entrepreneurs from wishful thinkers. A weak or unrealistic plan. I have seen businesses plans like that read like fairy tales. We will capture 10% of the market in year 1. Our sales will double every 6 months. We have no real competition. Banks have seen thousands of business plans. They know what realistic growth looks like. And they know what pipe dream sounds like. And here's the flip side. I have also seen great businesses get rejected because their business plan was boring, unclear, or didn't properly explain their competitive advantage. Your business plan needs the answer to 3 critical questions. How exactly will you make money? What makes you different from your competition? And how will you repay this loan specifically? How you can avoid this? Keep your projections realistic. If the industry average growth is 15%, don't project 50% growth without very solid reasoning. Be specific about your market. Instead of saying the Indian market for our product is 1000 crores, say our addressable market in Delhi and Bangalore is approximately 50 crores, and here how we plan to capture 2% of it. Most importantly, tie your loan amount directly to specific business activities. Don't just say we need 10 lakh for working capital. Say we need 10 lakhs to purchase raw material for our confirmed orders worth 25 lakhs, which will generate a gross margin of 8 lakhs over the next 6 months. Be specific, be realistic, be convincing. Alright, before we wrap up, let me give you a bonus insight that most people never hear about. You know what banks really want to see? Stability and predictability. They don't want to fund the next unicorn startup. They want to fund businesses that will reliably pay them back with interest. Boring businesses that make steady money are way more attractive to banks than exciting businesses with uncertain futures. So, when you are preparing your application, think like a bank manager, not like an entrepreneur. Show them steady growth, consistent profit, reliable cash flows, and a clear repayment plan. Quick recap for you is credit number one, credit score issues. Check both personal and business scores quarterly. Number two, documentation problem. Get organized 3 months in advance. Number three, cash flow confusion. Maintain clean documents, statements, and explain any patterns. Number four, collateral complication. Get proper valuation and clear titles. Number five, business plan blunders. Be realistic, specific, and convincing. Now here's your action plan of this week. Monday, you check your credit score, both personal and business, that is today. Tuesday, start organizing your financial document. On Wednesday, review your past 12 months of bank statement. On Thursday, get your collateral valued if you haven't already. On Friday, update your business plan with realistic projection. If you do these 5 things this week, you will be ahead of 80% of MSME loan applicants out there. And now that's the wrap on today's episode of Smart Credit Bytes. Remember, getting a loan is not about luck, it's about preparation and understanding that banks are looking for. Every rejection is just information telling you what to fix for next time. If today's episode helped you out, do me a favor, share it with another business owner or finance professional who might need to hear this. We are all in this together, and the more we share, the stronger our business community becomes. Got questions about anything we covered today? Drop me a message or a comment. I read every single one and often turn your questions into future episodes. Until then, keep building, keep growing, and keep making smart credit decisions. This has been Smart Credit Bytes. I am your host Sangeeta, and I will see you next week. Thank you.